Hello and welcome to FidelityConnects. I'm Pamela Ritchie. Fixed income markets entered the year on cautious footing, but have held up better than many might have expected. A pretty rapid shift in rate expectations has pushed yields to levels that we've not seen in years. And at the same time, demand for credit continues to outpace supply, even as issuance tied to AI, data centers, and energy infrastructure accelerates. And while volatility has hit commodities and rates, credit markets have yet to experience the kind of stress that forces broad-based selling. As our next guest puts it, quote, "We haven't seen the capitulation moment yet," end quote. So what does all of this mean ultimately for fixed income markets and portfolio positioning today? Joining us here today with his perspective on the key trends shaping global bond markets and where he sees opportunity is Michael Foggin. He is portfolio manager of the Fidelity Global Bond Fund, joining us live from London. Hi, Mike. How are you? Nice to see you.
Very well. Good to see you.
Thank you for joining us. And I think it's going to get dark in the window behind you as we have this conversation because it's you're closing out the day. So we'll invite everyone to send questions in for you over the next half hour or so. I'd like to ask, first of all, if you can help us understand whether we know or if you know what kind of shock this is.
Well, unfortunately, I don't have an easy answer for you. We don't know yet. We've certainly priced in some inflation expectations. We've seen some volatility at the front end of the government bond market. We've seen some drawdown in the equity markets, a lowering of multiples. But what we haven't really factored in yet is that sort of higher for longer energy price, which really could compress margins and could really force a bigger correction in the equity market, which would then flow through to the credit market and see wider spreads there. So far, I think the market is still looking for rays of light, looking for exits, and we haven't yet fully priced in it being structural, as we just don't know.
Okay, we don't know if it's structural, and what you mean by structural, I think, is whether we just live with higher energy prices for a longer period of time.
Absolutely. I personally don't see a way that we walk out of this with energy just moving back to where it was, a status quo. I think at the very least it's going to take quite a while to work through the backlog. And I think there should then be a risk premium attached to that. So I sort of feel like there should be something more priced in than has been so far. But we are moving from social media headline to
right.
headline, and it's very hard for the market to try and price that.
Take us back to the beginning of the year, which seems like a very long time ago. It was actually literally to the day, 33 months ago. And I mean, the world was awash in perhaps taking a look at the disruptions from AI, or that's come through probably in the most recent month. Certainly the discussion of international trade, perhaps less of the US exceptionalism, that's more of an equity story. But there was an international resurgence afoot. And where was AI going to hit? Tell us a bit about how you walked into the year.
Yeah, certainly. We walked in wondering what could possibly upset the market. Yields seemed pretty attractive in the fixed income market. We felt like economy is going to do pretty well, perhaps buoyed by some of the AI capex, also some fiscal spend from governments, not least Germany, with a huge fiscal plan. And so it sort of felt like while credit spreads were particularly tight, the disruption we were going to see was going to be limited to certain names and sectors. We can talk about that later. But it felt like credit spreads were rich, but all-in yields were pretty attractive. The one thing that was sort of the big issue that was on people's mind was the amount of issuance that was going to come from hyperscalers.
And it did come. I mean, we've seen a ton.
Yeah, absolutely. And the question about how the market was going to digest that amount of issuance was sort of felt like worry number one. Right. It's certainly not worry number one anymore, but it's still there. The amount of issuance that was done in 2025 was 5 times what was done in 2024. What's going to be done in 2026 will be at least double that. And numbers get up into the trillions, and quite how the market digests that is a question.
Is it oversimplifying to say that it's almost like it's not a new asset class, it's a fixed income and they're issuing bonds, but it's a certainly very new, large piece within the fixed income markets that's having its first big test?
Yeah, I mean, what we're seeing is issuance from high quality issuers, bonds from high quality issuers, often longer dated, higher rated than the index, but can grow to be, a significant portion of the index, bigger than perhaps banks or utilities, and to have this new cohort of bonds, which perhaps dealers and hedge funds and other participants can use as a beta, as a market barometer, as almost like a pressure gauge of, well, I need to buy risk, I'll buy these bonds. I need to sell risk, I'll sell these bonds. And that can be sort of, we've had it in the past with other sectors like autos or telcos. They're sort of the bonds that people reach to because they're easy to trade. You can trade large size in them. You can short them, and so they become the barometer of the market. And I feel that's where we may end up with these bonds. There's a lot of risk being added in, and I don't mean risk as in these are risky issuers. I mean longer dated bonds. When they move by multiple points, and they can impact your portfolio.
And they're being issued on both sides of the Atlantic. Certainly, we're seeing issuances, essentially by the hyperscalers, by the Mag 7, whatever you want to call it, on both sides, and as you say, very long dated. It's interesting to know. We know where that money is going, but the exposure within it, because we seem to still, and there always will be questions about this technological revolution, industrial revolution, whatever you want to call it, and just how well markets are priced for it right now. There may be some slides as we go along here. Just tell us about that risk and basically the AI disruption risk.
Yeah, so when we think about how AI issuers will impact the fixed income market, I sort of think about it in three ways. I think about the issuance, this huge amount of bonds which will be coming to the market. They're not price insensitive, but that they can certainly don't mind if spreads a little bit wider. Then I think about disruption risk. I think about issuers which may be in the portfolio or maybe in the index or sectors where their business model is impacted by this new technology. Thirdly, I sort of think, which is really hard to think, to comprehend sort of the macro impact of AI in the future and what that might mean for productivity, inflation, growth, etc. And then peripheral risk to that. But we talked about the amount of issuance that there is. I do think that is a test for the market to see how the demand that we've seen throughout 2025 keeps up with this amount of issuance. Now, given what's happened in the last month and the higher yields, I think demand will be pretty solid once we get some clarity on where the world is going. I think that demand will come back, so that piece of it feels pretty solid. The disruption risk, I focus much more on international markets,
right?
And they're much less exposed to the software and services that the US market has been. So, when I think about, whose business model is disrupted, it is issuers who are perhaps down the capital structure, down the quality structure, perhaps have issued loans, private credit or high yield. Software is a big part of those markets,
right.
and the market is trying to struggle with winners and losers. Who is fine, whose business model is still solid, and who perhaps needs to be re-rated. We've seen less of that in international markets, and so when we think about large sectors like utilities, potentially a winner with the increased energy demands, banking perhaps less impacted. The business model isn't that easy to step into. Insurance, real estate, etc. We're not seeing the whole market being impacted by AI. So therefore, it's sort of an idiosyncratic risk which you can manage within your portfolio. In the long run, what does AI mean to society? Well, it's a very big question, and quite how central banks manage to, navigate through the increased productivity with potentially, lower employment, etc. That's almost a story for further down the road. But for now, I feel like the issuance and the idiosyncratic risk is what we need to focus on.
Okay, and that's great. I mean, you're speaking here to Canadian investors, and the discussion of where to go to avoid AI disruptions was very much the question a month ago before the war became the frontline story, for sure. And we'll talk more about that in a second, because there's a lot to do with the energy for everyone. But in the sense that if you were to take a look at a portfolio of bonds that may be more internationally focused, you would probably have less exposure and therefore less risk to AI disruption. Is that right?
For sure. If the BDCs, the business development bonds that have struggled, there were definitely some winners in there, but there's just less issuance in Europe. Okay, there's less software issuance in Europe, and so if you were to look at a broad portfolio, you're going to have less exposure to that disruption in international. And as always, I always preach the more diversification, the better. I don't think you need to call these sort of big directional macro calls. Diversification will always be your friend.
So let's go to rates, and we might even be able to put that within the sort of framework of diversification, because it appears that perhaps the Fed has more of an opening just because they're up higher in their rates right now to decide what they want to do. Much of the rest of the world has finished their rate cutting cycle and is in a position where they were planning probably just to stay. They're at neutral on some level. And maybe the next move would be hikes, but not for a while. How much, it seems like that's entirely disruptive. You see movements constantly on this. Just take us through the rate story from your perspective.
Away from, gas and oil prices directly, I think the front end of government bond markets has been where it's really felt the most, the most volatility, the most disruption. And it's really a change from that either on hold to maybe we'll get a couple of cuts away. We think about the Fed or the Bank of England, to, I said, no more cuts, rate hikes. I think the market's priced in something like 18 rate hikes across developed markets. That's a huge shift in 1 month. We've seen a sell-off something like 70, 80 basis points at the front end of the euro market, 50, 60 at the front end of the sterling market, 50, 60 in euros, 30, 40 in dollars. Big moves, big changes of expectations. And that's because we've suddenly gone from inflation's under control to we don't know. We don't know. We don't know when it's going to, how long is this going to be? When's oil going to stop? How much is that going to flow through? Even if they decide it's over, when is the gas going to come back online? When's the oil going to come back online? And so it's a really uncertain picture. And so, that front end has really moved. I think there was some crowded positioning in there. I think people liked the shape of the bond market, as I mentioned at the start. The outlook was pretty benign when we opened. So a little bit of carry is always attractive, and a little bit of a cut here or there looks pretty good. Inflation seemed to be going pretty well, and so I think there was some flushing out positioning there. But those moves have been pretty intense. Pretty intense,
and I guess one of the questions that brings in sort of from the euro perspective. Let's bring in the war. There have been many different voices about who started, who's going to join in certain parts of the effort of this war to overall do lots of different things, but one of them that we're basically talking about is to bring energy prices down. And there have been fragmented responses to that. From the European perspective, in terms of what they need to do to make sure that they're issuing in ways that help them and help the world and so on, what should they do? Is there an increase in demand for issuance for utilities, for instance, to get energy pulled in from everywhere? What do we see on that? What increases?
Yeah. Well, Europe was really going under an energy transition already. Even prior to Russia, Ukraine, Europe was trying to greenify its economy. The Russian invasion of Ukraine really focused that, and the idea that they need to get off, non-domestic, energy sources, and they need to ramp up renewables. Pretty much is what they were looking to do, or get up on different gas sources. So that has been helpful to some degree, but gas is still, probably 25% of the energy demand in Europe, and a lot of that coming from the Middle East. So huge amounts of disruption. Hence, we've seen the big moves in inflation expectations, both in the UK and in Europe. And I think this conflict, this war, however it ends, will just go to focus the minds even more that we need, that each country needs some form of energy security, and they will continue to go down the path of renewable energy. And so I think that will lead to increased issuance from the utilities, again, similar to the issuance that we were talking about out of the AI companies, in that it'll be high quality issuance. It'll be, to some degree, the utilities are even more systemic to the economy. Is there some kind of implicit guarantee there from governments, perhaps? And so I think it's an issuance that the market will be happy to take down. But I don't see that that story diminishing. I think that continues to go. We'll continue to get increased issuance out of European utilities to deal with this.
One of the big stories from last year was the increased spending of governments in Europe on defense. I mean, Canada's in a similar position. Was that a huge story last year? Are we going to continue to see pieces of that unfurl? Is it a significant part of your business? I mean, how does that fit?
I think we continue to see that. Again, I think this will just go to intensify that need to increase spending. Now, there was always a friction between government budgets and the ability to spend, and can they put it off? But I feel like a colleague of mine has just come back from Europe, and he feels like that story is still well underway, and we'll continue to see increased spending from all the European nations. There's always a question of home bias and where will they buy the defense from? Can they do joint procurement? Could you see Germany, France, and Italy, even Spain together buying? And if they do, which defense company would they buy from? And so there is always a question of fragmentation in Europe.
Do they need a euro bond to buy it with, wherever they buy it from?
Well, we continue to think about this mutual issuance, and I think all of these situations, be it the sovereign crisis, be it the war in Ukraine, now the next energy crisis, I think that just pushes Europe closer together. I think the hurdles to mutualization of debt just continue to be moved forward. So I'm not going to say yes, it's happening next year, but I think the probability of it goes up every time we have one of these situations. Maybe you get a defense bank, and they issue similar to the European Investment Bank. Maybe get a European Defense Bank, and that was an idea that was being floated around at the moment. But anyway, I think all of this just pushes cohesion within Europe. It pushes Europe closer together, which I think will be a positive thing.
Tell us a little bit about risk appetite, and maybe even contrasting it to the beginning of the year. Once investors, I'm thinking of equity investors, but you can expand this. Once anyone gets sort of shaken through a big event, and I mean, there's still dip buyers in the equity market all over the place. So it seems like maybe it isn't a huge event yet, but were it to be so, in theory, you would see risk appetite for bonds increase, no? Or an appetite for bonds increase, essentially. Yeah.
The demand for credit was insatiable in 2025 and up until March of up until the start of this conflict, and the ingredients for that of attractive yields and questionable other areas to invest in remains, and if anything, it's increased with yields going up. I think that demand will still be there. I think we would need to see again some clarity on where we're going on the geopolitical side before you see that ramp back up again. But when you think about individuals and what they want to do with their savings, and you suddenly see a much more attractive fixed maturity, bond, I think the demand for that will continue to be high. So I do sort of expect that if we, have a de-escalation of this conflict, I would expect the fixed income demand to come back pretty quickly, and to see what weakening we've had in spreads, retrace pretty quickly. The alternative to that is that we don't get de-escalation. We either get a sustained, disruption, which then, as we discussed previously, really starts to hit, input costs, and therefore we can get a shade to the equity market, or we get some kind of escalation, forbid. And at that point, I think everyone steps away, and you get a gap wider in risk assets.
Right.
And that would be the point at which you would reset. And by a gap wider in assets, I'm talking about credit spreads doubling, and heading back to sort of certainly not COVID levels, but those sort of risk-off levels that we see every 5 years. And I don't see why I think we would have that now because we've seen so little volatility in credit spreads. They've been people don't want to sell them. So everyone's holding on to their credit, and equities are doing its thing and rates are doing its thing and vol's doing its thing. And we haven't had the capitulation where people sell their credit yet. And that's because they think in any sort of normalization, the demand is going to outstrip supply again, and you won't get the bonds back. So people want to keep hold of them. The fundamentals of the underlying issuers are all pretty solid. And so no one's looking at them thinking they're sitting on some problem child. It's the sort of continuation of disruption, in the Straits of Hormuz, or an escalation that can really cause that move wider in credit spreads. And then, as we've learned in the past, you have to be brave and buy. But it'll be very uncertain periods.
I mean, it's been said for, I think, months now that there's only one way for credit spreads to go. And nobody knew what the catalyst would be, because, of course, you don't. But, is this the catalyst?
We've seen probably, in the US and Europe, probably a 20% widening in credit spreads. And to put that in perspective, US credit spreads have gone from their first percentile, as tight as they can be,
right,
to their 10th percentile. Right? We're not near the median. We're not cheap, right? Or 20th maybe. And similarly for Europe, we've probably gone from 10th to 30th. We haven't got to a point where you can look at credit spreads and go, oh, that's cheap. I should be getting neutral there. And so, the supply demand imbalance that's been there remains, holding them very tight. And so, I don't think that's played out yet.
What do you think about the voices of central bankers right now? This is more sort of TMZ for, people who trade bonds. But I mean, what do you think about some of the comments coming out from central bank? Because we are hearing things like we're watching stagflation concerns very carefully. And I mean, there's a lot of comment and a lot of talk that could or could not be useful, I would imagine. I'm just curious what you think.
So I think there's it's a tough place to be right now, because we have, we have portfolios to manage and people's assets to oversee, but we can react on a daily basis, and we can mitigate risks, and we can get to neutral, and we can have honest conversations with our clients about, we don't know what's going to happen, but we think these are the risks we think you're facing. It's harder for a central bank when they can cause the issue. They can create more volatility if they start saying, well, that's it, inflation's here to stay and we're going to raise rates. That's not their job, is to create volatility. So sort of erring towards the wait and see side of it is essentially what they have to do. They have to take on board the data that they're getting, which is always backward looking, and the market is forward looking. So hence the market is priced in lots of rate hikes, and central banks need to say, well, the last data we had said that we were fine. So what do you want me to say? So it's a tricky situation, but the market is reading in rate hikes, not status quo.
So, I mean, just to sort of close out, take us through this a little bit. So the diversification in a global bond setting helps with sort of that discussion of what is exposed to AI, because global bonds are just simply less exposed, and there's a few reasons for that. Yeah. And then we have the concern about where rates go, rate risk, but ultimately sort of the moment that you will take us through, or you would take investors through, to step in when it looks like jaws are opening in the credit markets, which is a scary moment, actually. But for the investor who wants to sort of enter, what is this moment of diversification like?
So, the move we've seen higher in yields means that fixed income has, by definition, become more attractive. And the uncertainty that we're seeing in other asset classes and volatility makes some sense to me. I always think it's a good time to diversify, but when you've seen an underperformance of international rates versus US rates, I think that just adds to story that now is a better time to diversify. I find it hard to argue for a credit-heavy strategy when credit spreads are still at these tight levels. But a diversified portfolio that allows the manager to add risk when they see those opportunities is certainly something that I think makes sense. The ability for your manager to dial up risk quickly is probably more useful than to try and do it, very quickly, buy an ETF or something on your own, because the moves, as we saw in Liberation Day, I think the sell-off lasted about 4 hours.
Yes, it's very quick.
And then you couldn't buy the bonds anymore. So you have to be quick. And I'm not saying that's the situation that we're in here. This does seem to be a little more deep-seated. But we're running a portfolio which is pretty close to home on credit risk, with a little bit of a tilt to duration, and I expect it to and the liquidity to add the risk when we see that capitulation. Because the one thing about credit spreads is that they do overreact. At the moment, they're overreacting by staying too calm, and then we'll see them overreact by overshooting on the other side when they feel like there's doom and gloom coming. We saw that in 2022, and that's an opportunity for an active manager to then buy selectively the right bonds that are being sold by perhaps other managers.
Do you see the next while being a risky time? Like every indicator, when you're looking at Move, VIX, anything, like it's going to be a volatile time.
I do feel that way. From the start of the year when we're struggling to see what was going to upset the market, now I sort of wonder what's going to calm the market. I feel it's not a situation. The Middle East is not one that we can just have a sign off and tick and move on from. The disruption that's there is going to be with us for a while, and those higher energy prices feeding through the market are going to take a while to digest. And while they're doing that, there will be volatility in asset classes.
Yep. Interesting time to enter bonds. Okay. Thank you so much, Mike Foggin, for taking us through that. We wish you very well, and good afternoon to you.
Well, thank you very much. Good to see you again.
Thanks for watching or listening to the FidelityConnects podcast. Now, if you haven't done so already, please subscribe to FidelityConnects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.